How's it going, everyone? In this video, I'll talk about how I lost $1 million in my TFSA. You can check the timestamps if you want to jump to different sections in the video. For those of you who aren't familiar with this account, the TFSA here in Canada is somewhat equivalent to the Roth IRA in the US, meaning you can only contribute several $1,000s in the account per year, and whatever returns you get is tax-free. This is my story during the pandemic. At the beginning of February, I placed a small hedge in my portfolio against any possible crash. The main reasons why I made this play was due to the China shutdown and the unstoppable virus picking up in other countries. At the end of February to mid-March, I caught lightning in a bottle with my VIX call option contracts, essentially getting 100x my money within a 3-week time frame. I've made a video of exactly what happened and my thought process behind this once-in-a-lifetime home run play, boosting my 230k portfolio to 520k in mid-March when everything hit rock bottom. Gold, oil, stocks, bonds, consumer confidence, everything. All the black swans were out for a party. As you can see here, my account hovered around 500k mark for about 3 months. Then bam! 250. If you're new to this channel, consider dropping a like and subscribing. It really motivates me to continue making these videos. Thank you. Let's see the backstory here. The account reached 500k in March, again in June, but so many things were already falling apart in my investing approach. Being stuck at home during the pandemic for 100 days really took a toll on my mental health. My morning meditation and exercise routine somehow evolved to religiously checking the newsfeed on CNN, New York Times, and Bloomberg. I also opened a Twitter account to follow Trump's tweets and his daily rants on how well is done controlling the spread. I refreshed the pages probably 3 to 4 times an hour. They've all instigated me to go harder on the short side. Everything that I can find reinforced my shorting thesis. Books by Bolton and Trump's niece, Fauci dispute, Trump election rallies, etc, etc, etc. This is called the confirmation bias, where you screen through all the information out there to find the ones that aligns with your beliefs, even the ones that nobody would ever think of. I'll tell you the most ridiculous piece of evidence I found one night. It was 4 AM and I kept hearing these beeping noises outside my room. Then I got up to look around the house and it was my tankless water heater. Error code 10. I googled the cause and what do you know? It says overheating. Oh my god, that's the sign that the market is overheating and I need to short even harder. Jeez, thinking back, I just want to throw up. The deeper in the red I got, the heavier the short positions became, similar to the double down strategy at the casino. If you lose $10 in the first and second game, that's $20 total. The third game, you have to bet $30 in order to come out ahead overall. $30 gets you $60, so you'd be up $10. But if you don't win the third game, you'll be stuck $50 and you need to bet $60 the next game. It's a stupid play unless your bankroll and time is unlimited. Let's say somehow you lost 10 times in a row, your 11th bet would be $10,000. If you win this one, you'd be up $10 overall. But if you lose, you're down $20,000. Just think about the risk versus reward. That's the approximate time I made this video showing 24 reasons that could collapse the US economy via Jenga blocks. Boy, was I wrong. The second wave of the pandemic did come, but the deaths are now minimal since society is more cautious, and the healthcare personnel are well prepared with an array of treatments. Financial collapse of companies? Nope. Fed backstop all of them by buying junk bonds. We see my portfolio take the dive starting early July when the markets have recovered more than 50% and the Nasdaq was actually breaking highs. None of this makes any sense to me, and that's when I cranked up my short positions. We call it a dead cat bounce when the market drops steeply, bounce back 50%, then retest the previous lows. This theory worked during the last bounce early March, but investing is never that easy. It usually doesn't follow the same script. My max bet escalated to 350k on the short side. I had approximately 200 contracts of long put SPY options, meaning I was extremely bearish on the S&P index. At that time, the SPY was at $300. The 300 contracts represents $300 times 100 shares per contract times 200 contracts equals 6 million exposure. So if the markets tank 10 to 15%, my account would hit that $1 million goal. Of course, that didn't happen since the old cliche of don't fight the Fed won out, and the markets continued to rally up 15+%. It's still a ridiculous chain of events in my opinion. but a loss is a loss. Mr. Market is always right. At the beginning of August, I had to cut my shorts when my account balance tanked back to 250K. Since I like to follow Warren Buffett's #1 rule, never lose money. I started the year off with 230K, got it up to 530, then right back down to 250. Coming down certainly hurts a lot more than the ride up, I tell you. The theory behind this is called loss aversion. People are usually twice as unhappy losing $1,000 than winning $1,000. Except my amount was 250 times that. Ouch. So I had to throw in the towel and settle the shorts. Then I made some long-term investment plays as usual. I handpicked 11 game-changer stocks that I think would win out in 10 years. These positions would be locked up like the stocks in my other accounts. I felt the prices were high, so I only put 60% of my cash in action, saving 100K on the sidelines from a long call options play, whenever the market finally decides to correct itself. I remember there was a point when I said to myself, screw it, I'm all in. Either bring my account to $1 million or zero. Thinking back, this is definitely a loser's mentality. Why did I even need to rush to get to the $1 million milestone? I could have stuck to an all-weather balanced portfolio and got there within 5 to 7 years. That's when you should realize your mental state has collapsed and should talk to someone about it. Getting a third person's point of view is always good, since they're not emotionally attached to an account or ridiculous plays. Therefore, their view would be much more logical. This alone would bring a lot of investors to a depressive state. But wait, this was only a quarter of the story. Here's how I lost another 750K. Near the bottom in March, I had implemented my bullish thesis to long call on all 4 mega stocks 2 years out. That's Microsoft, Apple, Google, and Amazon. It's pretty much saying they'll break new highs within 2 years. I had no idea if the stocks would bounce back that quickly, but subconsciously I knew it would come back. But it did just that and much more within the past 6 months. My plan was to put 10K in each of these 4 stock options every single month. Here are the contract prices I bought on March 20th. Microsoft at $11, Amazon at $120, Google at $106, Apple at $19. I probably stuck with it for 3 months until Amazon broke out to new highs. I had to sell them to cover my short positions. Here it shows that I sold my Amazon contracts for $405, profiting close to 30K. But that didn't matter since I sold them to cover my loser shorts. Here's where I need to shake my head. Rookie move. You should always be letting your winners fly and losers die. My other Microsoft, Apple, and Google holdings were settled shortly after for the same reasons. Let's see what would happen if I stuck with the plan. As of today, August 30th, 2020, these are the option prices. Microsoft at $52, Amazon at $11.50, Google at $460, Apple at $190. Absolutely ridiculous. Both Amazon and Apple had 10x returns from my original 10K investment, while Microsoft and Google had a measly 5x. I calculated what my 10x monthly bet would have been worth. These 6 months of 40K each was 240K investment total, and now it's worth a whopping 750K plus. Subtracting the 240K principal is another 500K here, making 2 bad plays that cost me 750K cold. Converting that into Canadian dollars is approximately $1 million tax-free. It's sickening. Would've, should've, could've. I just really wanted that win. Having lost in each and every direction for the past couple months, $1 million tax-free. It hurts no matter how you think about it. Here's a comment I made in my video mid-March. I'm accumulating ammo waiting for the vicious bounce. This is a once-in-a-decade opportunity. Don't miss out. I certainly obliged for the first half of the equation, accumulating all these sweet polymer bills, but then just throwing it all away. The best part of this nightmare experience is that I get to share it with you and possibly improve on our investment philosophies through my mistakes. Before I proceed with the lessons learned, have you made any mistakes during the crisis? Maybe the rest of us could pick up a thing or two for the next battle. Okay, number 1, house money mentality. I had this feeling of invincibility. The 250K I got within weeks was treated like it was house money and it didn't matter. But you need to realize that a dollar is a dollar, no matter how you got it, in what time frame, and whether luck or skill was involved. It's kind of like having a gambler's high at the casino. Imagine you've been on a huge winning streak at a poker game, running you $100 to $1,000, let's say. That's when we feel the invincibility, especially after a few drinks. You start raising with pretty much any 2 cards like the deuce 4 suited, since you have luck on your side and your birthday is February 4th. Ridiculous, right? But you've forgotten how you got all these chips. By playing a strategic discipline game with premium cards in advantageous positions. But that doesn't matter because it's house money, right? Heck no. We need to treat every dollar with respect and remember how much work it took to earn your very first. For me, it was probably scrubbing kitchen tiles on my knees for 15 minutes with a toothbrush and some Vim. It's a great lesson for your kids to teach them that money doesn't grow on trees, but off your knees. Number 2, focus on what you're good at. Looking back at how I grew my TFSA from 50k to 250k, it was never about making the all-in home run 5x play, especially within a time limit. I just picked great companies that had potential to double and held on until the market realized its true value. It was a grind to say the least. I'd go out to test the products, observe the market adoption during the iPhone and Nintendo Switch era. I rarely looked at macros, political trade war, virus counts, etc. I didn't care. And when the stock prices take a hit from these special events, that just means I could buy more at a discount and hold. So why did I bet half my portfolio on this economic event? I'm not an economist by any stretch. Just a simple investor looking to make a buck or two consistently. Number 3, keep your physical and mental health in check. My fitness peaked in March when I completed my first triathlon, and that's when my portfolio peaked. Coincidence? I think not. Then due to the pandemic, the only exercise I was getting was 10,000 steps a day, which is nothing, considering how much crap I was eating, consuming pizza and chips at any hour of the day. This isn't exactly considered brain foods. I find that meditation has given me clarity to the decision-making process. It usually filters out a lot of noise that could lead to poor judgment. Number 4, put things in perspective. There were times I found myself looking at these numbers with zero attachment. 100k weekly swings wasn't out of the ordinary. I have a personal goal to sponsor 2 kids a year with World Vision and possibly change 100+ kids' lives in 50 years. On average, the sponsorship lasts around 10 years. At $30 a month, $360 a year, that's $3,600 per child. That's $360k to meet my 100-kid target. This cool million could have been invested in the 4% dividend stock to cover all my monthly donations, and I'll still have $1 million+ in the account after 10 years. It could really make a difference in the very real world. Number 5, investing is a marathon, not a sprint. Chasing returns isn't exactly healthy. Say if I did get $2 million with my speculative short, do you think I'll stop there? Most likely not. I'll continue to chase the next million and millions after, through reckless plays, and I could easily lose 500k plus in the next year when I adopt the gambler's mentality. Overall, I felt like I failed in both my bankroll and emotion management with these speculative plays in my TFSA. It's a good thing I have multiple brokerage accounts to mitigate against this scenario exactly. It's time to move on. There are better things to focus on life than reading daily news and predicting stock actions. I find that the average investor would make a lot more with the simple strategy of buy and hold. Looking back, the more actions I made, the more mistakes I made. And I even had a feeling that I was out for revenge with a huge bet. This crisis completely derailed my investment philosophy to make correct decisions consistently. It'll certainly haunt me for the next little while, since these $1 million swings don't happen too often, especially on the downside. Well, this is my story of how I lost $1 million in my TFSA. I really wish it could be the other way around. I guess that video will have to wait. If you made it this far in the video, I gotta click the thumbs up button for you. Much appreciated. I hope you won't make the same mistakes I have. As always, thanks for watching, take care, and I'll see you in the next one.